Hi, good morning. I am going to talk about ELSS. ELSS is basically equity linked savings scheme wherein you can save taxes in the long run, provided you are you've invested in this scheme. I'll just explain. I'll just take you through a brief presentation. So basically, ELSS, like how a Swiss knife offers various functions, same way ELSS offers various, ELSS does various functions. It has a lot of features actually. I'll cover one by one. ELSS is basically a wealth creation scheme. ELSS, as the short acronym goes, like equity linked savings scheme. In an acronym form, we call it as ELSS. Wherein, if you are investing in ELSS, you can save tax. That's the basic purpose of an ELSS fund, along with the wealth creation capacity. You can do SIP through ELSS. ELSS scheme gives you a feature of ATC, wherein you can save tax. That is, like, suppose considering you are in a 30% tax bracket, wherein ATC offers you up to 1,50,000 rupees as an upper limit in ATC. ATC, a lot of financial products comes under ATC, like Public Provident Fund, which is PPF. Even it includes your EPF, insurance premiums that you are paying in, and the list goes on. ELSS is one among the ATC products which is authorized, which is coming under the ATC section of government, wherein we can claim exemption in the income tax up to 1,50,000. And these schemes have a short lock-in period compared to other financial products. ELSS offers a lock-in of 3 years, wherein other financial products which provides ATC benefits has a more lock-in, even more lock-in period as such. Since ATC is offering us ATC with a shorter lock-in, one may consider this actually. Just a second. Yes, one may consider ATC. One may consider ELSS, which offers ATC as well as it offers a shorter lock-in period as such. And as discussed, it gives us tax savings in the long run. Whatever you are investing in the ELSS fund, it gives you tax savings which you can use that particular year itself. It is convenient to use. It comes under mutual fund scheme, as we all know, and it is the majority of the assets, underlying assets in the equity scheme, in the ELSS scheme, is going to be in equity as such. And it comes with a growth in the long run. ELSS products inbuilt feature, wherein growth in the long run can be expected. Growth and wealth creation can be expected in the long run. And as discussed, tax savings, one can invest up to 1.5 lakhs. One can use ATC through ELSS products. It is taxes deductible up to 1.5 lakhs in a year. And this product has a shorter lock-in of 3 years, minimum of 80% exposure in equity, as we discussed earlier. And you have a choice of mutual funds to invest actually. And you have a flexibility. There is no predefined commitment. You can invest through SIPs also. There are products which are like, there are financial products which are too rigid or rigid. But in this case, ELSS offers you the flexibility of investments, wherein you can opt for lump sum plus SIP, or only SIP, or only lump sum. It is your choice. And the flexibility of the product is also given to you as such. And wealth creation is possible in the long run. I will cover a little bit more on this in the final part of the video. wealth creation is possible in the long run, and it has been proven over the years, actually over the decades. And again, reiterating, the ELSS is an equity mutual fund category. Investments in, so again, to stress upon on this, the equity ELSS is an equity mutual fund category. Though you are able to save your tax, like if you are having a deduction of 1,50,000, if you're falling in 30% tax bracket, you can save up to like 46,000. You can save up to 46,000. 1 minute, I'll just show you. 45,000 plus, exact number is 46,800 per annum. You can save it, including the 4% cess on income tax, 30% tax slab, including 4% tax cess on income tax. So again, whatever generally equity mutual fund, whatever risk an equity mutual fund carries, the same applies to ELSS as well. That has to be considered. Investments in ELSS qualify for tax deductions under Section 80C of the income tax up to 1.5 lakh limit in a financial year. Yes, you can use it in a financial year up to 1.5 lakhs. Investments in ELSS have a minimum of equity exposure of 80%, which technically can go up as high as 100%. Yes, 80 to 100%, the fund manager can maintain the equity portion in the underlying fund. ELSS has the flexibility to invest across market capitalization. Yes, ELSS is a kind of multi-cap strategy. It can invest in across market capitalization, be it large cap, mid cap, or small cap. The fund can invest in all the market capitalization category. There are over 30 plus different ELSS schemes to choose from the market. Do check the stated objective of the fund scheme when investing to know specifics. Yes, when you've decided on the ELSS scheme, which scheme to go about from the 30 plus schemes, you'll have to read between the lines. You'll have to understand the fund or funds before investing. Yeah, these are all the basics. You need to have the KYC. You need to be a KYC compliant investor. You can invest as low as 500 rupees. That's the beauty of ELSS. You are getting an opportunity to save tax. And suppose in ATC itself, if you would have utilized like 50,000 or 70,000 from some other instrument, still you can use 70,000 through ELSS, or you can save as minimum as 500 rupees, 1,000 rupees, 5,000, 10,000 rupees in ELSS to start with. Later, you can increase your investments. That is up to you. Depends upon how much provision you have to save on ATC. But good news is you can save as less as 500 rupees in a year. And these are all the basics. And once your investment is completed, you can use the account statement sent by the AMC. AMC is nothing but asset management company or mutual fund company. You can use this use that statement for the record purposes, and you can save the tax on the on that particular financial year. ELSS has two unique features. One is high equity exposure. Yes, it is coming with a high equity exposure, and it has a short investment tenure of 3 years. The 3-year lock-in means that you cannot sell your investment before 3 years from the date of purchase. That is what the 3 years lock-in mean. If you have a minimum of 3 years, you can consider ELSS. There is convenience to start a SIP with ELSS to make tax savings the regular exercise than rush towards end of the financial year. A lot of people will chase like in the month of February and March, or January, February and March, JFM in financial industry parlance. Basically, rather than rushing towards the tax saving instruments in the long run, it's better to save or invest from the beginning of the year. That is always advisable. One is you are avoiding the last minute rush. The second point is you can get the better benefits of compound interest if you are investing in the beginning of every year for another decade plus. In case of an ELSS SIP, each SIP installment is locked in for a period of 3 years. This has to be noted very carefully. If you are investing in lump sum, yes, it is easy to calculate. One is you are starting at a point, and after completion of 3 years, you are exiting from the investments. Yes, that is easy to understand. After 3 years plus, your lock-in is relieved. Whether you want to exit that time or you want to exit after 5-7 years, after the lock-in is over, that is completely your choice. But if it is a case of SIP, each installment has a lock-in period of 3 years. For example, if you are exercising an SIP for 12 months for an entire year, each of the installment has to go through the 3 years of lock-in. So 1 year of your investment period and 3 years of lock-in. Almost, if you take each entire 12 installments to come out, you might have to give 3 + 1, 4 years, because you have done SIP for 1 year and waiting period for each monthly installments for another 3 years, which is 4 years plus. If you are doing an SIP for 5 years, again, you'll have to consider a 5 + 3 years. Total investment is 8 years. That includes your 5-year investment period plus 3 years waiting period. The same applies to long-term investing as well. 10 years plus 3 years, 13 years plus 3 years. If you have a time period of 20-25 years till your retirement, you can invest every year in ELSS, and you can save tax as well as you can build your wealth. ELSS is a twin engine. One is you are saving your tax, and second, your growth is channelized through an ELSS scheme, because it's an equity scheme. Except the PPF, gains in all other tax saving avenues are taxed partially or totally. ELSS offers better post-tax returns. Yes, in PPF, whatever gains you are taking out is exempted from the tax. I think even in insurance schemes, life insurance schemes, it is exempted from the tax, the gains, whatever you are making. Insurance schemes, what I mean is the endowment schemes. I'm not talking about ULIP here. I'm talking only about the endowment schemes, PPF and endowment schemes. But all other revenues are mostly taxed either partially or totally. But ELSS provides better post-tax returns. A better post-tax returns in the sense, suppose assuming you made a 12% return over the years, 12% return over 10 years, CAGR, 12% CAGR. Long-term capital gains from ELSS is taxed at 10% as on 2022 status. So long-term taxation on ELSS is 10%, let's assume. So 12% is the CAGR. 12% minus 10% is, even if you leave the 1.2% of the ELSS CAGR, whatever you've got, you've still made 10.8% as a long-term real returns, post-tax returns. Compared to other products, it is attractive even after you pay the tax. That is what is better post-tax returns means. Long-term capital gains of up to 1 lakh a year from ELSS mutual funds, including all investments, are exempt from income tax, with gains above this limit being taxed at 10%. Long-term, suppose, let's assume you made a 20 lakhs profit over the years. You've utilized the entire 10 years from now. Every year you're investing 1.5 lakhs, for example, and 20 lakhs is your profit, roughly as an example. And on the 20 lakhs, 1 lakhs is going for an exemption. 19 lakhs gains out of the 20 lakhs long-term gains, you are getting an exception of 1 lakh apart from the gains, whatever, apart from the tax benefits, whatever you are getting from the scheme. Beyond that, you are getting 1 lakh because it's an equity scheme. Exemption of 1 lakh because it's an equity scheme, and on that 19 lakhs you are going to pay 10% tax. Still, it's a better better post-tax returns, and you have a maximum potential tax saving of 46,800 per annum. Yes, this includes the cess on income tax as well. So these are all the benefits. You are getting ATC benefit, short-term lock-in of 3 years, equity exposure. You can invest through SIPs, and no maturity date as such. You do not have a maturity date. You can prolong your investments. Nobody is going to say like you will have to take out the money in so and so date. You can prolong your investments. And choice of funds you have in ELSS category. It inculcates savings discipline. You have higher potential returns, tax efficient on exit. This we have discussed, and wealth creation in long run. And as I said, I will cover about wealth creation in detail. I'll cover a little bit. I'll spend more time on this area. So again, conditions, mutual fund investments are subject to market risks. Read all scheme related documents carefully. Now coming to the workings on the wealth creation part. See, the example what I have taken is, you are investing 1,50,000 rupees every year. That's what we have discussed, right? You are investing 1,50,000 rupees every year for another 10 years, right? 1 lakh, that is the example I'm taking here. You are saving tax of 46,000 plus in the presentation what I've shared you. But here, for the ease of calculation, I've taken only 45,000 rupees, which is I'm considering a 30% tax bracket person, wherein he'll be saving 45,000 rupees plus. That savings also, I am considering that person, he or she is investing in an equity scheme. So the investment is coming up to 1,50,000, which is the ELSS 100% qualification, ATC. I'm considering that in ELSS 1,50,000 plus 45,000 of his savings, his or her savings. And every year, apart from this year, he or she is going to invest every year for another 9 years, which is current year plus 9 years is 10 years. So 1,95,000 is going to be deployed every year for another 9 years also, including the current year. So total years is 10. I am assuming a rate of growth as 12%. So his current portfolio would have grown to 5,40,000, which is his current 1,95,000 on this year. And his annual lump sum, whatever he is doing for another 10 years, that 19,50,000 is going to become, might become 32,27,003. So totally adding both these investments, it is 37,67,754. Let's round it off to 38 lakhs. One, he or she is saving on tax savings is coming every year for another 10 years, as well as wealth is also created. I've assumed the 12% CAGR, 12% return compound interest over a period of 10 years. So 37 to 38 lakhs has been created after 10 years, as well as taxes saved. Twin benefits on investing in ELSS actually. Thanks a lot for watching this video. Keep watching this space. More to come. Thank you.